this is forexbrokers.net, and we continue our trading academy with gaps and how to interpret gaps, how to trade gaps in the currency market, taking into consideration that that gaps or the interpretation of gaps comes from the stock market back at the start of the 20th century. And there are two approaches to gaps that you will find in this article, together with the issues of market gaps and how gaps form on the currency market and how gaps form on the stock market. As you can see here, there's a problem already with this chart here, because depending on the broker that you use, gaps length may differ. A gap refers to, at least on the currency market, refers to the empty space that forms on the chart. And usually, most of the times, 99% of the cases, a gap forms over the weekend or between Friday's closing price and Monday's opening price. However, some brokers show the Sunday candlestick, some others do not show the Sunday candlestick. Sundays, there is trading activity for a couple of hours in New Zealand, and in New Zealand already being Monday morning, but in the rest of the world being, in the rest of the Western world being still Sunday, so that's the name for the Sunday candlestick. And some brokers decided to take that candlestick to eliminate that candlestick, and therefore the size of a gap is different on various brokers. In this case, our example that we used two examples in the article, and you will see them both here in the two videos that come with this topic. This example here, this is called a Macron gap, because this gap on the euro US dollar and actually on the other euro pairs formed when the French president Emmanuel Macron was elected in April 2017, and now we are in 2020 by the time that I'm doing this video analysis. So 3 years ago this gap was in place, as Macron's views were on the right side, on the right wing's views, and he was viewed as also as embracing the European Union, the Eurozone, the pillar of the European Union, the euro, and so on and so forth. All in all, the outcome was being viewed as positive for the European Union, for the European project, and the euro pairs gapped higher. Euro US dollar closed here and gapped higher. Now I chose the levels here with the exact levels from a different broker, as this broker here chooses to show also the Sunday candle, but this is the real dimension of the gap. 0.7327 was the closing on that Friday, and 0.8376 was the closing, the opening on when trading activity began after the weekend. Now, gaps are being viewed or are being treated in using two approaches. One of the approaches called the Western approach, coming obviously from the United States and from the way the United States interpreted the stock market, especially the indexes. And the other approach comes from Japan, as the Japanese technical analysis increased in popularity in the West as well, especially after at the start of the 90s, with the book written by Steve Nyssen that introduced Japanese candlestick patterns, and also a different way to look at gaps, as you are about to find out. In any case, according to the Western approach, a gap, or the market, should close a gap. If this is the gap, then the focus in the Western world is that the market should come and close the gap. So if the gap opened, or the opening level is or was 0.732, we should see this closing. There is a controversy regarding to when to the timing of the closing of the gap. Some argue that it should come in the same day. Some argue that it should come in the first trading week, and then if not, just drop it. Some argue that gaps are always closed, and on various markets that would not be any open gap left. Well, I don't know about that, but what I can tell you and what I can show here on the currency market is that gaps do not always close on the same day nor on the same week, and maybe they will close sometime, but for the currency trader it is extremely expensive to remain on the short side. Imagine that you sell here. This is a gap, a relatively big gap from 0.732, 0.837. We talk about 100 pips and more. So if you short here for 100 pips and more for the lower edge of the gap, waiting for the gap to be filled, then you have a big problem, because the market, not only that it didn't fill the gap, but if we zoom out, it moved from 0.8 all the way to 1.20. Moreover, if we further zoom out, we see that it corrected from the 1.20 here. It corrected a bit to 1.15, and then it made another push higher to 1.25. Now, I don't know if you are a strong believer that gaps eventually will close, then that's okay. But to keep a short position from here for 100 pips, only to see the market going against you thousands and thousands of pips, then pips points, then that simply doesn't make sense from money management point of view, from a disciplined trader point of view. Eventually, as it turned out, this gap did close, but not at that point. Not at that point. Remember, the starting point was 2017 when Macron was elected as the president of France. But it was closed recently. It was closed on the 19th of March 2020. So 3 years later, let's zoom out. 3 years later, the gap eventually, the market eventually closed this gap. No trader should suffer this kind of pain, and no investor should look at this one, except if there is a bigger opportunity or a bigger account or a bigger strategy laying down the foundation for it, and the gap to be just a simple thing that needs to be closed eventually. But otherwise, this is not supposed to happen. So this is the standard interpretation of gaps. The Western approach, it doesn't quite work in the FX market, at least not in this case. In many ways or many times it does work, as you will see in the next example, in the next video. But the Japanese approach would be even more interesting than this one. Stay tuned for the next video, please.